Yeah, I'm losing my
Another
edge.
chance to buy metals. We've got metals markets moving right now. They've been moving lower all week. They've moved lower multiple times over the last couple of months, but they've always seemed to bounce back, Pete. And that's why I talk about another chance. This is one of those, if it ain't broke, don't fix it trades, right?
I agree. And you know what? This has worked well for us. We put this on yesterday. Long spree, short GLD. We're obviously underwater on it. I talked to our friend Tom Sosnoff into the same trade today. Actually, long gold, long yen, which is not working as a great pairs trade at the moment. But I like. You got to let it settle.
Yeah.
This is when you got to go let it settle. This is when you stay small on. So, but down $1.20 in spree is definitely. You know what? If we're going to accept, we're going to trade the new range till the market, not us, but the market tells us not to. We're in the zone.
And I'm glad you brought it up that and with that context, because we are that spree market that has stayed above $70 since summer 2020, Pete. At this point, almost a full year.
Right.
We don't want to, we're not the types that are going to outsmart ourselves and say, for the last several months here, this market is going lower than 70. Because every time you do that, Pete, it's bounced back, it's bounced back, it's bounced back. So actually, let me highlight that even further here. I'd much rather look at the fact that the market has stayed above 70, it's bounced off of 70 multiple times, and play that angle, knowing that if, a big down day today, we're underwater on the position, if the market moves below 70 like it hasn't in the last several months, then I was wrong and I move on. And that to me is such a simpler way to trade, Pete. Just trading this bounce, that something that tends to happen more often than not, as opposed to being on the side that, a lot of people love to be on this corner of being like, doomsday is coming, this market is going to crash, or, what have you. And though it's maybe more bombastic and more fun to be on that side, it's not as profitable as it's been to try to catch these bounces.
And you know what? You make a great point because like we always believe, the market sets the range. We just, we avail ourselves of it. So it means two things. One, that we're going to be wrong eventually, sometimes sooner, sometimes later, but you're going to be wrong. So just accept that. We know that within the 50-50 world, we're just trying to move the odds out, and we never move it to 90%. We move it out to an acceptable point. And the idea of what you just mentioned, which is really truly a momentum trader. Oh, this market is showing me that the next trade is going to be 65 or below 70. That is a very difficult trade, because if you think about it, fine, your strategy is your bearish metals. Fair enough. Now, mechanics, which we argue in the static delta world, are so important. How do you set, if you're selling them here because you think the next print is going to be 68, and just that's fine, because that's your bias. But how do you set up your mechanics? Where does the market and its range show you you're wrong? 76, 77. I know I'm not waiting to that. That is the challenge with momentum trading. It is very tough. And you look back at some of the moves from last year and even this year. Sure, if you jumped on, there are parabolic moves up and some things down. But I think that is the challenge when you start to look at that. And, not to say that the range moving forward from the end of March through June, the second quarter, is going to be 65 to 70. It may very well be.
Sure.
Equally likely, it could be 80 to 85. So all I'm doing is taking what the market's giving me and trading that range till it stops working.
Yeah, man, it's very well put there, because I bring back to this chart, and whenever it's not necessarily going against trend followers or momentum traders, but you've got a market that's shown that it is not dipped below $70. So you maybe have a higher probability of success playing the fact that it will continue in this range, because if you're going for that trend following momentum trade, the only successful trade you've really had is this one right here.
Right.
Because, the early part of 2020 were between $50 and 65. Right. The last 6 or 7 months, we've been between 70 and 85. And so we just prefer to, trade on the market continuing to stay in its range.
Right.
And we're going to add some options to maybe even build some more confidence and probability in our favor here in a second, as opposed to getting, in my view, too smart with a trade and being like, I mean, whenever you have to stick your neck out and say, this thing is going to do something that it hasn't done before, it is, like I said, maybe a cooler corner to stand on, but it's not a more profitable one 9 times out of 10. And we are trying to, at the end of the day, with futures trades, get closer to 9 times out of 10 than 1 or 2 times out of 10. And I want to look here at, the
I'm
fact
glad you
that
mentioned that, because if you think statistically, that thought dramatically lowers your number of occurrences. So
yeah.
Again, we want to be, in a perfect world, we'd want to do 100 trades. And some of the most successful firms in the world, it's not us, are 52-48. So they're wrong 48% of the time, but they do it so frequently, they make tons of money. We like to move that bar a little further. But if you think that you're bringing, as you just examined, I'm not doing 20 occurrences, I'm doing 2. You think about the flip of the coin. Even if you move that 50-50 out a little bit, the likelihood of both those being losers versus the 20, it is the problem. So that is where, and you pointed out, the likelihood of you trading those extensions, whether or not they're right. And we do see those momentum trades tend to catch us. And that's where we manage losers. And that's why we set mechanics around them. But the number of occurrences, and Tom and Tony constantly speak to this, and this is the reason why we want a larger number of occurrences.
Yeah. And so with that, I want to further increase the odds by, maybe I'm not so sure that it's going to bounce off of 70 or 71 or wherever it happens to be today. Pete and I were early to this market yesterday. It's another full dollar lower in spree futures. But what we did was we added some short options, some short call options in gold ETFs or silver ETFs. And here, Pete, I wanted to pose this because I put the same Rorschach test in front of my very good friends, Liz and Jenny, earlier today. And they favored, selling calls in the outperforming silver here, as opposed to the underperforming gold. You can see that if you're looking at call options in GLD, you're probably looking more at like a call spread that's 30 or 20 deltas. If you're looking at silver call options, I would look at maybe 2 or 3 naked call options around the 30 or 20 delta, because SLV is a smaller product. Which of these setups do you favor here, Pete, when you're looking at buying metals with the SPRE futures down this week, down another dollar plus here midday on Thursday? But putting the odds a little bit in your favor, increasing that probability of profit with either a call spread in GLD or the naked calls in SLV.